Yo, what is up, everyone? Welcome to my Startup Traction Hotline, aka my office hours, here every single Thursday at 10 a.m. Pacific. My name is JDM, aka Josh David Miller, aka J Doom, the shredder of business models and the wearer of colorful shoes. I will prove most of those to you today, though we probably won't get a chance to see the shoes that I'm wearing, which are purple. So, but we've got some awesome questions today. So we're going to talk about investors and what investors are looking for. We're going to do a pitch deck review for somebody who's looking to raise some capital. We are going to talk about traps that founders fall into. We're going to talk about all kinds of just really fun stuff with marketing. I'm really excited. It's been a while since I've been here, and it's just gonna be a lot of fun. It's really good to be back. So happy to have you guys hanging out with me here today. So without further ado, let's just go ahead and let's dive in. We're gonna start with some of the investor parts of this, and then we'll move into some of the other things. So we're gonna start with a question from Nick. And so Nick wanted to talk about messaging to investors, and I was just going to go ahead and share his question here. And so he basically, broadly speaking, how you recommend messaging or understanding what the correct type of funder is for your startup. We'll read VC theses and where they funded, and we precisely see alignment, but articulating that fit seems to be missing the mark. Thoughts? Okay, cool. So there's a couple of reactions that I have to this first. So the big reaction that I first have is like, well, if you are a good match for the thesis of an organization, for those of you who aren't familiar, investment firms of funds usually have some type of thesis. And it is, largely speaking, you can think of it as their promise to their investors, so the people who put money into the fund, about the kinds of startups that they're going to invest in. So that is the stage of the startup. It can be certain verticals or industries, or other things that they might be saying. Maybe they're only interested in regional biomedical startups, that kind of thing. Stage, certain founder types that might have diversity requirements. It's all different kinds of things, and we just bucket these into a big category that we call the thesis of the firm. So if you have alignment with the thesis of a firm, then just repeating back the language that they use to describe their thesis should work. Like, why would that, right? We're a founder, we're in this region, we're at this stage, we're in this kind of startup, we're looking for this kind of investment, this size check, and so forth. And so if that doesn't work to just parrot back what they're looking for, then I don't think the thesis match is really the issue. And it is important, now just as a quick aside, you do want to make sure that you are looking at a match between what they're looking to invest in and your startup itself. If not, you're actually just wasting both of your times, and that's just not fun. So I don't know why you do that. So it's great that you're looking for that, but if just parroting it back doesn't work, the problem probably isn't the thesis. The first thing that comes to mind is that it's not about fit in thesis. It's actually about being fundable or not. The most common reason that startups don't get funding, largely speaking, not on a one-on-one basis with a particular startup, particular funder, but just having trouble getting funding, is that they're just not fundable yet. Most founders think that they're fundable way before they actually are. And so without any details, I only have what Nick wrote here. I can't say whether or not that's true here, but my gut says that it actually has more to do with whether or not you're fundable for the kind of investors that you're reaching out to. You might not even be fundable at all yet. So that's just something to keep in mind there. Okay, so we're going to talk more about fundability with some of our other questions. So I'm going to pause here, and if I don't answer this, then definitely hit up in the chat, and we'll come back and we'll circle back to it. So our second question is one that that Mark, a friend of the show, actually sent in. You can send in a video question too if you just go to jdm.bio/ask. You can record a video response. You could type in a response. You can record an audio response. And if you do video or audio, I'll actually go ahead and play it, as we're going to do here for Mark's question. So Mark, I give you the floor. Take it away.
Hi, JDM. Welcome back. And I do have a question, actually a couple of them, but one is that I'm looking at trying to continue with validation, which I'm saying, wow, it's been a while that I keep going in this path, but I need to get in front of people. So how do I get in front of the right people, not customers? I'm thinking about pitching. And when am I ready to pitch? Those two things, and meaning that, do I just shoot from the hip? I want to be more prepared but I don't want to just be going down the path and burning hours on something that may not take off, at least at this time. So there you go. Hope you have a great.
All right. Thank you so much, Mark. That's a good question. It's great to be back. Thank you for welcoming me back, and welcome to March. So, good questions. I'll leave the traction piece aside for now because you didn't really provide enough detail in there. We'll build on the investor part of this. So there's a few things I want to say about it. First is it's never too early to start establishing those relationships. So if it's just a question of like, do I start talking to investors or do I not? Always yes. Your net worth is your network. So it's definitely worth it to start building those relationships. But it can be too early to make an ask. And so be really cautious about doing that because you can burn bridges. I'm going to come back to that in a second because I know that was a big part of your question. The second thing that I'll say is like an expectation setting thing. A lot of people think that raising an early round of capital, like from angel investors, a pre-seed round, or maybe even leading into a seed round, is something like Shark Tank, where you go and you talk to a couple of investors, and you throw out some numbers and like, I'm in 15% for X dollars, and we're done. And this is not the way the world works at all. Investing is like sales in a way, and that you're actually going to have a CRM like system. You're going to pitch 100 times over 6 to 9 months trying to get those early checks if you're lucky, and that's if you're fundable too, because there's just so much that goes into that. And early stage investment is even harder because it's the riskiest kind of investment. So you have to get like really good alignment with the investor and with your startup and with their thesis, like we were talking about with Nick's question, and so forth. So it's a drawn out process. You have to manage it like a sales process, literally set up a CRM, HubSpot or whatever, and actually get just tons and dozens and dozens and dozens and dozens of founder names in there. And you're going to be reaching out. Most of it's going to be cold, and you're going to try to get those early meetings and so forth. So it's a big drawn out process. So I wanted to set that expectation too. That leads us into the question of like fundability and whether or not you in fact are fundable. And so there's a certain set of things that an investor is looking for. We're going to break these down in a couple of different ways. The first way to break this down is with the credible theory of hugeness, which is a nifty turn of phrase that Alex Blumberg, who is the founder of Gimlet Media, came up with. And I really like it because it's nice and nice and succinct. It's 3 words that all are doing some heavy lifting. So if we take them in reverse order, so credible theory of hugeness, start with hugeness. The hugeness aspect of this is that if you're getting equity investment for something, you have to have the potential to grow really large. It's money for equity. It's not a loan. It's high risk, so they need high reward. And they're looking for 10x, 20x, 30x returns on investments, 100x returns sometimes, right? They're looking for these really big outsized returns on their investment. And in order to give those, you have to have the ability to grow really, really large. So the first thing you have to demonstrate is like there's this hugeness aspect to the thing that we're growing. There's a really big market. So the next thing is like, okay, we're going to get huge. That's how you're going to get your money, but we're not huge yet. And because we're not huge yet, we have to get there. So you have to have a theory about how you're getting from you, which is small, to large, which is very much not. So you have to tell the story about how that's going to happen. We're going to have this go-to-market. We're going to get in here. Yeah, there's competitive. We're going to differentiate in this way. And we're going to defend against, future competition or current competition of the market like this, and there's this whole elaborate theory. And the further along you are, the more elaborate and specific that theory is. But of how you're getting from this current state, which is really small, to the future state, which is really large. So you have to have a theory of hugeness, right? A theory of how you're getting from small to large. And that theory has to be credible. That's the other part of it, is that it can't just be this, cockamamie back of napkin plan for how I think we're going to get there. You actually have to have some evidence behind that theory of hugeness, and that credibility is in both the people. So you have to we're the right team for this. You have to have evidence that this is the right timing for this. You have to have evidence from the market, from customers, that you're on the right track, that there's a there, and that you're in a good position to get that to that there, and so forth. You have to have evidence of that. You have to have credibility that this theory is right. So you have to have a credible theory of hugeness. That's broadly what investors are looking for. And before you have a credible theory of hugeness, reaching out for investment is probably a waste of time. Aside from the friends, family, and fools round, which is so named for obvious reasons. So that's broadly speaking what an investor is looking for. And so what those individual details, like the theory itself and its detail, the credibility that has to go into that theory, that really varies based on stage. So really early stage startups, something like a friend's family of fools or leading into an early angel, that kind of like pre-seed money that can be sort of thin and light. And a lot of it's based on maybe relationships or founder reputation. But if you get over to Series A, for example, you actually need like pretty good, compelling, robust evidence. You need evidence of growth, like double, triple, where you're just actually, doubling, every year, that kind of thing. Or you need like really good evidence from the market, really, which is traction, right? You need a really compelling team, and so forth. And there's a lot that goes into that, but that evidence and theory gets more robust the further along the fundraising process you are. So that's a big thing to keep in mind, is that those details are going to be based on the stage. But the earliest possible version of this is still going to be, you have some real traction with real customers in the market. You have an idea of how you can get large. It's not a cockamamie scheme. It's not give me money so I can buy Instagram ads and that's how I'm going to get big. It's a credible theory of hugeness. You have to know actually how you're going to get there. That's what you need to actually start a fundraising round. So hope that was helpful there. We're going to talk a little bit more about fundraising, because we're going to do something a little bit fun. We're going to do a pitch deck teardown. It's gonna be a little fun. So we're gonna review a pitch deck that was sent in just this morning from a friend of the show, June Swatzel. Hey, June, how are you this morning? I see you in the chat there. So June's got a startup called Organic Nearby. I do have some little background on Organic Nearby, because June and I have crossed paths a number of times across different events. But this is the first time I'm seeing this pitch deck, so I'm actually going to be reviewing it in real time, live, and I'm just going to sort of respond as somebody who's seen more than 1,000 startup pitches, sees startup pitches every single week and evaluates them professionally, exactly how I'm thinking about it, stream of consciousness style, while I run through the pitch deck. So it's going to be a little raw, but I think it's going to be a little bit fun. So without further ado, let's dive right on in to Organic Nearby's pitch deck. Throwing this in here. Let's make that a little bigger. Cool. Let's do it. All right. So here we are. Title slide. Okay, it's a pitch deck, creating a sustainable food ecosystem. I'm not sure entirely what that means. I'd love to hear a bit more about on this slide, like what Organic Nearby actually is. What does a sustainable food ecosystem means? Like, who is that for and why? So I think the XY might need to work here, but it's not terrible. It's fine. It's fine. Cool. Move on. All right. So the problem. Let me actually get rid of the overlay here, because I think that's kind of getting in the way a little bit. All right. Cool. Problem. Farmers face challenges distributing their products and maintaining profitability. Okay, so a couple things here. So just on the design or aesthetic itself, they're pretty colors. You got photos, you got stuff like that. But you have this as header. This is problem. I would rather actually have the problem be the header. What like you want to drive it in? I don't need to see the header of problem. I want to actually see what the problem is. So again, if farmers face challenges distributing their products and maintaining profitability, like that's not specific enough. I don't know what that means. I'm not getting any severity or urgency with regard to that. What is the consequence of that? Is it lost productivity? Is it dollars? Like, what is the actual pain that these farmers are experiencing? So dial it down. It's just a little too vague. It's at the elevator pitch level, and I'm sure if you were pitching here live, you would have some of that detail orally, but it needs to be written down in here again. So, okay, next slide. Solution. So again, same thing. It just says solution. All right. An online search engine focused on this community of growers and consumers. Okay. So the first thing I see here is solution is a search engine, which means that the farmers and there's somebody else there that's also doing the search. So it's a two-sided market. And yet I only heard a problem from one side of the market. So whoever the other side of the market is, I needed to see their problem too. And I don't know what it is. Okay. So we have some really small font here. So another thing is never use font smaller than 30-point font when you're doing a pitch deck. There's just too small font here. But let's see. Organic Nearby is a force multiplier, amplifying the growers' reach and impact. That's marketing jargon. I want something more specific than that. It connects consumers concerned with supporting local growers. That makes sense. Okay, great. We created an ecosystem supporting a circular economy. I'm assuming that's a reference to sustainability, but I think I'd like that fleshed out a little bit more. Organic Nearby is unique by consolidating all local online food channels. Okay, so we're starting to get what the thing is, but you don't actually, aside from it's a search engine, you don't really say what it's doing here, like and what the magic is, but the magic secret sauce behind it. But it's not bad. It's okay. I'm getting the picture. I can go on. I want local produce. I can go on. I can search for local produce. I'm kind of getting that. Okay, cool. But again, The problem did not speak to me, the searcher, right? Why is this important to me? So there's another problem here that needs to be addressed for a two-sided market. Okay, business model, advertising, affiliate display features. Okay, so the first thing is here, a couple things. So one, in order for advertising to work well, you have to be able to scale just fucking huge. It's one of those models like you're going to be running in the red for a long period of time while you can build up a massive user base so that you can get specific and targeted ads. Either that or the ads are going to be low dollar. Either way, when we're talking about that credible theory of hugeness, I'm not seeing the hugeness here. Like even if you get really large, the dollars aren't going to get really large. Advertising, I'm honestly just super skeptical of that model, of that business model to begin with. And we're talking about affiliate revenues tends to be pretty low, display ads and so forth. And so featured products is probably the more interesting thing there. So I'm a pretty skeptical of the business model. So that's just something that comes to mind with regard to that. All right, opportunity. The organic food market is growing rapidly, with the global market projected to reach 320 billion by 2025. We are first mover advantage emerging fresh. Okay, so again, buzzwords, first mover advantage, and also I don't want to see any of that. The organic food market is growing rapidly. Okay, that's great. You're talking about timing there. And then the global food market is the global organic food market is projected to reach 320 billion. I don't know how much that tells me about this because they also sell organic food at Safeway. And I'm sure that this is included in that number as well. And so you're after the local market. So I want something a bit more specific. I also want to know, like, what is the dollar amount that you're actually going to be able to get into here? What is the local market for organic foods? Like, what does that translate to in dollars in terms of sales? And again, going back to the business model, it's not clear how that translates to your opportunity because I don't know what the advertising is. Look for that. Is there dollars spent on advertising right now? In the local organic space, what does that look like? It doesn't connect back. And then you say, first mover advantage in the emerging fresh local food distribution. So, well, first I'll say this is not the first local organic search engine that I've come across. So not first mover. A lot of startups have tried in this space and failed. So I don't think that that's probably accurate. But also, in addition to that, the first mover advantage is pretty overrated. Most people end up pretty bloodied. When we think about like big market disruptors like Uber, we tend to think of them as like, oh, they came in and they disrupted the market and they have first mover advantage. And that's why Lyft never caught up. But you might be surprised to learn that Lyft got to market before Uber. So fun backstory there. Okay, so anyway, the opportunity isn't really speaking to your opportunity is kind of what I'm seeing here. Okay, competition. Great. Yes, let's talk about competition. Other search engines. Okay, Craigslist doesn't highlight local food. Google's a wider net, not fresh local. Amazon is targeted to buyers. Okay, Google and Amazon aren't ones I really think for local organic produce. Maybe they are, and I'm just kind of missing that, but I don't think so. So what are people doing right now to try to find local organic produce? Is it the farmer's market? Because that's not listed on here. That seems like it should be a thing. So like what are people actually doing right now in order to get around not having organic nearby? Like what are they actually doing at the end of the day? And I didn't know Craigslist had food. Oh, it doesn't highlight local food. Okay, so then they're not competition, or are they competition? That part's not clear to me. Okay, cool. Moving on. All right, customer acquisition. Yes, important. Good. Content. I don't know what that means. Targeted blogs on social media. I see. It's a content strategy. Search engines and farm groups to reach potential customers. Building strong relationships with local farmers and grocers. Collaborating with university agricultural extensions. Example, University of Idaho recommends us as a marketing resource for farms. Okay. So, okay, like some of those partnerships, that actually makes a lot more sense. I would highlight that a bit more. And I want to hear more about what the strategy is for that, as opposed to just you happen to have a relationship with the University of Idaho. Like how, again, the credible theory, how are you actually going to get more of these universities? What's in it for them? How are you going to do that? What does that strategy look like? Then you have building strong relationships with local farmers and grocers. That is just, every business is going to say they're going to want to build strong relationships with their customers. So that's not a strategy. Like how are you actually going to build those relationships? What does that look like? And then content, like content's hard. Content's a really hard game. Content's long play. It takes 2 to 3 years to like really get good content and build a big audience around something like that. So that's why there's the old joke about like the founder who has a product. It's great. Customers like it, but she needs to get in front of customers. She knows her customers are on Twitter. So she creates a Twitter account for her startup. Now she's got 2 startups. Right, because Twitter is very hard. Content is a hard game to get into. So I'm pretty skeptical of that as a customer acquisition strategy in the short term. Long term, it might be amazing, but it's highlighting as your number one customer acquisition strategy in the deck actually makes me super skeptical of your ability to not just go into the red in a year, right? And never get me my money back. Okay, moving on. Retention, maintaining up-to-date and accurate product information, promoting new products, educating, highlighting seasonal growing information, leveraging community agricultural videos. I actually don't think I care about this at this stage. As a separate slide, I don't think we need a customer retention slide. I'm not sure why that's super relevant, because it's produce is something that you buy ongoing. So I think that's probably self-explanatory, but it's not bad. It's fine. Okay, financials, looking to raise 150K of seed. And then we have a use of funds here. So this is great. So prove out a viable business model that will allow us to scale, prove out a better means of getting products from a farmer to customer, increasing site awareness, traffic and engagement, support. So fine, but there needs to be the use of funds is only going to be interesting if you actually break down what percentage of funds are going where and what the metrics are. How much runway does this actually buy you? And what's the next thing? Is this getting you to a Series A? Right? And what does that look like? How are you actually going to, $150,000 gets us to where? So if you're getting institutional investment from a fund, they are only going to make money if you get to that Series A. Otherwise, they're never gonna. So they're gonna want to know how to do that. And if they're an angel investor, again, they're gonna be looking at roughly the same kind of thing. They're gonna want that to convert at some point. So that's that. The second thing is okay, 150K is a lot based on what I'm seeing here. There's 150K is a low seed round, right? That's pretty small by most modern. Probably the average, I think, is several times that when we're looking for a seed round, but that's not necessarily an issue. But because customer acquisition is going to be the hardest part, and you have a two-sided market here, again, I remain highly skeptical of 150K even getting you where you want to go. Plus, you don't have specifics here about how it's prove out a viable business model like that. You're telling me that you don't have the one thing that I'm most concerned about, and yet asking me for money. So I'll kind of leave that there. We at that. Okay, leadership team, great. Co-founder, developer, designer. Okay, fine. And then advisors. Okay, fine, cool. All right. Yay. Okay. End of the deck. So cool. So I'm going to actually shrink this down a little bit here so I can do some more talking, but I might still reference this deck. Okay. So all right. So yes, June's in the chat. Great. You're very, very welcome. So let's talk about what I actually heard here from a meta level. So now I'm going to try to summarize, having seen this deck for the first time. So when we think about investment, we're looking at basically, 6 T's, the letter T, right? We're looking at roughly 6 T's. Different people look at it different way, but I'm going to use this method. So we have team, TAM, timing, traction, terms, and technology. Just kind of going through those. So team is, are you the right people? Do you have enough, sufficient credibility relative to your current stage to actually execute on this and get shit done? So that you did have some team in here. I'm just going to go ahead and check the box for now without diving in any more to that. You had some people, so cool. And you're pretty early stage, so it's not like you need the biggest rock star of the CTO world. Okay, so then so that's team. Then we have timing. So you started to address this early on, where you talked about the growing organic food market. I want to see more about that. Why is this the right time? Organic's been a thing for years. Organic saw unprecedented growth. What was that, 8 or 9 years ago? Why is now 2023? We're at the end of the end of Q1, right? Why now? Why is now the right time for that? So I'd love to see more about that. TAM is the other one. And this is related to this. And this is what I was saying was kind of missing here, which is what is the action? So TAM stands for total addressable market. And this is what we're talking about. What's the actual size of the opportunity for organic nearby? Where are you making that play? If it is the 320 billion, which again, I'm highly skeptical of, then I need some more detail around that. Otherwise, we want to know what that looks like here. So in terms of I'm not even seeing what the size of the opportunity is here. So there's that. So we have team, TAM, timing. The next one, I'm going to leave traction for last. So we have terms, which is going to, okay, so it's, you're asking for 150K, then there's the equity that actually goes into that and several other things that go into terms. I'm just going to throw that aside it doesn't matter for right now. So I'll throw terms aside. So technology, this is your IP. And so since you're actually a software startup here. You have a search engine here. The technology is literally your tech. If you're not looking at, for those of you who aren't working on a software startup, your technology is anything that's defensible. It's your IP, it's your processes, it's whatever you're doing internally that is your defensible magic secret sauce, even if that's just team knowledge and so forth, like a vast experience if you're a service company. Looking to scale. So setting that aside, since you're a software company, this is like literally what this thing is. And so I want to know more about this. Why is this a defensible position? Why isn't another player able to come in and make a play in this space? So it'd be more about competition, more about why you're well suited to be defense, and not just saying you're the first mover. Like that is absolutely meaningless to me. I want to know, like, we're in this position. Here are the other people are going to be creeping up on us, and here's why. And here's why we're in a better position to do this, and why somebody can't just go ahead and spin this out. And it might be your relationships. It might be other things. So technology. Okay, so I said it's going to leave traction for last. So traction is the thing that I actually did not see really anything of in this deck, unless I missed it. The closest thing I got to traction was when you mentioned on the customer acquisition slide here that you've got, I think it was the University of Idaho, to be one of your referral partners. So they're not even a customer, but they're a referral partner for customers. So how many customers do you have? What's the revenue outline now? Are you pre-revenue? If so, why? And then why? And it might just be because the revenue models, advertising or whatever, but are you pre-revenue? Sounds like maybe you are, but who are the customers you have? What's your customer acquisition costs look like for them? How are you actually getting them on board? What does that look like? Sales process and so forth. So I didn't see anything about traction in here. So that box is a big X. So that is my reaction to this whole deck in about 15 minutes. And so 30,000 foot view, the big things, the big takeaways that I would say is that based on this deck, startup not fundable, definitely not ready for 150K. I'm going exclusively based on what I see in this year deck. So I'm not saying that you are not fundable, but based on this deck, nowhere close to fundable. Lot of work that needs to go into actually getting that to at least the presentation and maybe part of the business as well into a position where somebody's going to be willing to inject capital into it, particularly at 150K, because it's probably, you might be able to get again, a fool to invest, a friends, family, and fools round who just happen to have more money than, or more dollars than cents, right? And who will invest in it, and that's great if you have those relationships. But outside of that, you're going to be looking to raise from multiple individuals. So again, you're going to pitch dozens and dozens and dozens and dozens of times to try to get to close that 50K to 150K, and you're probably going to be doing 20K checks, 50K checks, that kind of thing, to try to close it. So okay. Yay. All right. So that was that. I had fun. I hope you guys had fun with that one too. I am kind of interested in doing some more of these pitch deck teardowns. If for those of you who out there doing it, if you want to do that, hit me up. You can get my email address if you just go to jdm.bio, and you can hit me up on social, or just throw me in the comments here, and I'd love to talk about maybe doing another teardown if you're looking to get some investment. So that was our pitch deck teardown for organic nearby. Let's move on. I think we got time for maybe one more question, then I'll have to kick the rest to next week. So the next question that I want to bring up is from Zakaria. And this is a really good question. So this is on what are some of the key metrics to set for a software startup that would lead to successful traction. So metrics, yay, love metrics. It's a big concept, it's a lot of fun, but it's one of those things that are really poorly understood. Because when we think about metrics, we usually think about things like sales, we think about revenue, we think about market share, we think about customer acquisition costs, maybe lifetime value, retention, right? We think about all those traditional metrics, and those are amazing metrics. And for a software startup, those metrics are super important. Eventually, they're not important from day one, because from day one, all those numbers are functionally zero. Right? At some point, they are literally zero. And then as you make progress, they're not zero anymore, but they're still functionally zero. Like no matter how many customers you get, your market share is still like a rounding error of zero until you actually get really far into the market. And so measuring those things doesn't help you to determine whether or not you're on the right track. Just as a random example, let's say you get your first customer, it's $10 a month SaaS. And okay, great. So we went from $0 in monthly recurring revenue to $10. We increased by infinity%. Well, that's obviously useless. But then we add in a second one. Well, now we doubled our revenue month over month. Well, did we though? I mean, like, yeah, but it's not useful. So we need a different way to handle accounting. All those metrics that I'm talking about, like things like revenue and lifetime value and retention and so forth, they're all lagging indicators, meaning they tell us what happened yesterday and whether or not what happened yesterday was successful. When we're in an early stage startup, we don't care about yesterday, we care about tomorrow. And so we want to not look at the lagging indicators from yesterday, which is what we find on the balance sheet, those metrics that I'm talking about. We want to find the leading indicators that say we're on to something successful, that we're going to be successful tomorrow, right? That we're on the right track. And so we call that innovation accounting. And the basic idea is that if you take this chain of indicators, these chain of leading indicators that say you're on the right path, and they all just literally one after the other, they chain together, building and stacking on top of each other, the last link in the chain will be those balance sheet metrics. So in other words, if we're successful here, we can move on to the next chain, the next chain, the next chain, and eventually we're going to see that show up in sales. And that gives us something that we can measure today. So if you think about startups as a process, if you think about startups as a spectrum that you go down, we're looking at something roughly speaking like, okay, we have to find a customer that we can get in front of. We have to make sure that they have our problem. If they have a problem, we have to make sure that they want a solution, meaning it's urgent and severe enough for them to want to pay for a solution. Not just any solution, but then they have to want our solution. And once they want our solution, they have to be willing to pay for it. They have to, we have to retain them, and they have to refer others, and so forth, right? So you have this long spectrum of potentially leading buckets, at least, of indicators. So for any startup, the right thing you want to measure right now is, if you think about that whole chain, is the earliest part of that chain, or let me actually flip that around. It's the latest part of that chain where you don't yet have robust evidence. So if you've already found that there's this population of people out there who have this really big problem, and and I can get in front of them on LinkedIn, great. You've got some robust evidence. There's a path to get in front of them. You understand them, and you know what their problem is. They're resonating with the problem statement. That's great. Maybe they're responding to your email or responding to an ad, or they're getting on the phone or whatever. But like, yeah, there's some people out there. They got a problem. It's pretty cool. Then you say, okay, well, now that they do that, are they, is it urgent? Is it severe enough? Do they want a solution? And that's going to look different for each one, but maybe that's something that's coming out in customer interviews. So then you get some good data on that. And then you move on, you say, okay, well, now that I'm getting customers to resonate with the problem statement, and it's urgent and important, I want to see if they resonate with the solution. So that's when I try to get them to respond to our value proposition. Well, they then, not just seeing the problem, but if we expose them to our value proposition, will they click? Will they reply? Will they do, but just based on wherever you're finding them, are they going to engage with the value proposition in a way that sends a signal that says that they like this? Because if they like it, great. Eventually, maybe they'll pay. Like down the line, we can get customers to pay. But if they're not even resonating with the value proposition, it does not matter. If like those downstream metrics, the money part never matters, because they never wanted the product in the first place. The amount of money is going to make that work because they didn't have the problem, or they didn't have the value proposition didn't resonate with them, and etc. Right? So you want to find the earliest possible indicator that you can measure right now for which you don't have robust evidence. Or if you think about the whole chain, what's the farthest point along where you stop having robust evidence, and that's the point you want to measure. As some examples, real quick, I would say that a good example for an early stage startup might be the actual number of customer interviews that you're doing. So if you're reaching out for customers on LinkedIn, let's say it's B2B play, and you have a customer identified, and so you can find them on LinkedIn, fantastic. So you start sending InMail. Then the earliest metric that you're going to look at is how many of that InMail gets a response. And if your ask in the InMail is for them to hop on a video call with you just for a customer interview, right? So you say, I'm looking to talk to people who have this problem, who look like you. I'm just looking to gather information. I don't have anything to sell you. I'd love if I could get 5 minutes of your time, happy to pay you for it, or whatever. If you get a high positive response for that, that's great. You're getting resonance with the problem. If you get a low positive response, then it either or a negative response, you're not getting any responses, whatever case is, then at that point you're getting a signal that either you have the wrong problem, the wrong audience, or maybe in the wrong medium. Maybe LinkedIn isn't the right place to find these people. So, and so then, okay, now we got to experiment on that until we find that high positive response, and we get some robust data, and then you move on to the next stage. So good luck with that. So that is that. I have, you guys sent in tons of questions, but that's kind of all we've got time for here today. So I'll save a couple of these other questions for next week. And if you guys have questions, definitely, again, hit me up. You can ask them in the chat in real time if you want to, or you can just, hop on over to this URL and you can record a video like Mark did and submit that in real time. If you want to do a pitch deck teardown, email me or tag me on social because this form won't let you upload it. But reach out to me. I'd love to do a few more of those. Now, the last thing I'll say is just a little, shameless plug here is that if you are looking for some feedback on your pitch and you're serious about it and you want to do that, I do actually offer some coaching so that you can actually just book straight away. If you go to my website, you can grab it straight from there. In fact, here's a short little thing here. If you go there and click the work together link there, you can actually just book time straight on my calendar. We get together for 90 minutes. We go through, you pitch to me, we tear it down. We talk about the slides. We talk about the parts where, how do we get your story in the maximum possible way to have the best resonance with investors? How do you reach out to the right investors? Like, what does that match look like? And then also probably some of the areas where maybe you need to work on getting to a state where it's fundable. Maybe you don't have enough traction. Maybe the team isn't right or whatever. So we can point out some things that you can actually work on. So if you're interested in that, hit me up. Happy to work together. Otherwise, that's kind of it for now. I'll be back next Thursday because we're here every single Thursday. So it'll be March 9th at 10 a.m. Pacific, right here on either YouTube or Facebook or LinkedIn. So thank you so much for joining me today. Have a fantastic rest of your day, and I will see you guys next week. Peace out.